Hello, property investors. If you're planning to invest in a rental property or assessing the profitability of your current one, understanding return on investment, or ROI, is essential. ROI gives you a precise measure of your property's financial performance and helps you decide whether to retain, improve, or exit an investment. In this video, we'll explore how to calculate ROI on rental property investments effectively and what key factors you should account for to maximize your profits while reducing risk. Whether you're a first-time buyer or a seasoned investor in the Bengaluru property market, this guide from SANGAU will give you clarity and confidence in your real estate decisions. 1. Understanding the true meaning of ROI. Return on investment, ROI, is a cornerstone of real estate investment analysis. It's a percentage that shows how much profit you're making in relation to the total amount you've invested. For rental property investments, ROI is calculated by dividing your annual net profit by the total invested capital, then multiplying by 100. For instance, if your rental income minus expenses yields Indian rupee 300,000 per year on an Indian rupee 30,000 investment, your ROI is 10%. This figure allows you to objectively compare properties and assess the financial strength of each investment over time. 2. Calculating net operating income, NOI. Net operating income, or NOI, is the income your rental property generates after all operating expenses are deducted, but before mortgage and tax payments. This includes costs such as property management, maintenance, repairs, insurance, utilities, and vacancy losses. For example, if your gross rental income is Indian rupee 600,000 and your expenses are Indian rupee 200,000, your NOI stands at Indian rupee 400,000. This figure is a fundamental component of your ROI and should be monitored regularly to ensure your numbers reflect actual performance. 3. Including the complete investment amount. When evaluating ROI, consider all costs, not just the purchase price of property. These include registration charges, stamp duty, closing costs, interior work, furnishing, and any other improvements. A property purchase at Indian rupee 50,000 could easily escalate to Indian rupee 60,000 once all expenses are added. Calculating ROI without including these figures results in a misleading impression of profitability. Accurate investment tracking is crucial to making informed decisions in real estate investing. For considering mortgage and EMI payments, if your rental property is financed, your mortgage payments, especially the interest component, impact your ROI. Annual interest paid should be deducted from your NOI to reveal your actual cash flow. For instance, if you pay Indian rupee 240,000 annually in EMIs, your net profit reduces accordingly, while principal repayment adds to your asset value. The interest is an out-of-pocket cost that must be factored in to understand your true return. Clear accounting of your financing structure leads to a realistic ROI. 5. Adjusting for vacancy periods. No rental property is rented out all year without interruptions. Vacancies due to tenant turnover are normal and should be included in ROI projections. If you anticipate 1 month of vacancy per year, deduct 1/12 of your annual rent from income estimates. This adjustment results in a more conservative and realistic ROI. It also prepares you for fluctuations in rental income, allow you to plan your cash flow better, and avoid financial surprises. 6. Depreciation and tax considerations. Though depreciation is a non-cash expense, it carries valuable tax benefits. In India, property owners can often claim depreciation on the building to reduce taxable income, which improves after-tax ROI. Understanding how depreciation, income tax on rent, capital gains, and expense deductions affect your returns helps in optimizing your rental property strategy. Staying informed about the tax structure ensures you're not leaving potential savings behind. 7. Assessing cash-on-cash return. Cash-on-cash return offers a practical view of how much you're earning based on your actual cash investment. This method is useful when properties are financed because it excludes borrowed capital. For example, if you invested Indian rupee 10,000 in cash and your annual net income is Indian rupee 100,000, your cash-on-cash return is 10%. This indicator is especially valuable for comparing leveraged properties and understanding your short-term gains versus long-term equity growth. 8. Estimating long-term appreciation and equity growth. A smart investor knows that ROI isn't limited to annual rent returns. Property appreciation over time and equity built through loan repayments significantly contribute to total ROI. For example, if a property bought at Indian rupee 50,000 appreciates to Indian rupee 70,000 over 10 years, and you pay down a large portion of the loan, your wealth generation is substantial. Factoring in these long-term gains provides a holistic view of your investment success and future potential. 9. Comparing ROI across different property types. Different properties generate different returns. A premium apartment in central Bengaluru might offer lower rental ROI, but higher capital appreciation. Meanwhile, an affordable unit on the city outskirts may deliver higher rental yields with slower growth in value. Calculating and comparing ROI across locations and property types gives you insight into where to allocate capital and which properties are helping or hurting your overall investment portfolio. 10. Leveraging technology for ROI accuracy. Today's digital tools can help simplify ROI calculations. From ROI calculators to advanced property management software, technology allows you to input variables such as income, expenses, loans, and tax data to produce detailed financial insights. These platforms also allow scenario simulations, such as rent increases or renovation costs, to show how changes will affect your ROI. By integrating these tools into your property investment strategy, you reduce guesswork and make smarter, data-driven decisions. Bonus tip: how SANGAU helps you maximize ROI. At SANGAU, we focus not just on managing properties, but on enhancing your financial returns. Our property management services in Bengaluru offer you monthly financial statements, rental tracking, and insights into tenant retention and property upkeep. We help you identify underperforming properties and suggest strategies to improve NOI. Our end-to-end services, from marketing to tenant screening and proactive maintenance, ensure your property performs at its best with complete transparency and efficiency. Partner with SANGAU for a professional approach to rental property ROI that drives real results. Thanks for watching. If you found this guide on calculating ROI helpful, don't forget to like, share, and subscribe to our channel. Stay connected with SANGAU for more expert insights on property investment, rental income strategies, and smart property management in Bengaluru. See you in the next video.